Gold just suffered its sharpest one-day drop since 1983. Friday, January 30th, 2026. Gold fell over 9% in a single session. Silver plunged 27 to 28%. The worst daily fall on record. Most people believe this is a Trump repricing, market exhaustion, a healthy correction after years of gains. The data show something different. This is a coordinated liquidation event, a margin trap designed to reset the 2026 debt cycle, and the fingerprints are already visible in the fine print. On January 13th, 2026, CME Group changed the methodology for calculating margins on precious metals. Then, over a single weekend, they pulled the trigger. Gold margins jumped from 6% to 8%. Silver margins surged from 11% to 15%. The math is simple. The trap is not. Today, I'm breaking down the three-stage mechanism behind the 2026 margin liquidation. Why this crash was inevitable, why it's not over, and why the gap between New York and Shanghai is the only price that matters now. A mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The margin hike that broke $7 trillion. You see, margin requirements are not static. They're a weapon. CME Group controls the leverage allowed in futures markets. When they raise margins, they force traders to deposit more cash to keep their positions open. If you can't meet the call, your position gets liquidated automatically. On January 30th, 2026, CME raised gold margins from 6% to 8%, a 33% increase in collateral requirements overnight. Silver was worse. Margins jumped from 11% to 15%, a 36% increase, which means every trader holding paper gold or paper silver woke up to a cash demand they didn't expect. Funds scrambled, brokers sold, the cascade began. But here's the black magic most people missed. This wasn't a one-time move. CME changed the entire calculation structure on January 13th, 2026. They switched from flat dollar amounts to percentage-based notional margins. The old system used fixed dollar values, $5,000 per contract, $10,000 per contract, static numbers. The new system uses percentages tied to the notional value of the contract, which means as the price of gold or silver rises, the margin requirement rises automatically. The trap tightens itself. You see, in the old system, if gold rallied from $2,000 to $3,000 per ounce, your margin stayed the same, $5,000. In the new system, your margin scales with the price. $3,000 gold means higher notional value. Higher notional value means higher margin. The system punishes you for being right. Plus, this change went live 2 weeks before the January 30th crash. The fuse was lit on January 13th. The bomb detonated on January 30th. The math was always going to force a flush. Let's add the numbers. Open interest in COMEX silver futures peaked at roughly 620,000 contracts in mid-January 2026. Each contract represents 5,000 ounces. That's 3.1 billion ounces of paper silver. At $110 per ounce, the notional value is $341 billion. When margins jumped from 11% to 15%, traders had to produce an additional $13.6 billion in cash. Overnight. Most didn't have it. Forced liquidation followed. The sell orders flooded the market. The price collapsed. The margin calls triggered more selling. A feedback loop designed to break leveraged longs. This is not market mechanics. This is extraction. You see, the 2026 debt cycle is entering its terminal phase. Commercial real estate debt is maturing. Regional banks are sitting on hundreds of billions in unrealized losses. The Federal Reserve cannot print away the maturity wall without collapsing the dollar entirely, which means the system needs liquidity. Real liquidity, not paper, not promises, cash. And the fastest way to generate cash is to force liquidation in the most leveraged markets on Earth, precious metals futures. The CME just executed a $7 trillion margin call across global commodity markets. Gold, silver, copper, platinum, all hit simultaneously. The cascade was not random, it was a protocol. If this mechanism just clicked for you, or you want to track these 2026 debt traps as they emerge, join the Forensic Circle by hitting subscribe. We track the fingerprints they try to erase. Let's move to the deep dive. But even this $7 trillion flush is a distraction from the real trap hidden in the structure of your holdings. Because while New York crashed, Shanghai kept climbing. And that 11% premium gap is not a pricing error. It's a legal confession that your paper claim is not the same as physical metal. The fine print in UCC Article 8 just became the most important contract you've never read. February 2nd, 2026. COMEX paper silver is trading at $98.50 per ounce in New York. Shanghai Gold Exchange, physical silver is trading at $110.17 per ounce, an 11.8% premium. You see, premiums are supposed to be temporary. Shipping costs, import delays, local demand spikes, these create small gaps, 2%, maybe 3%. 11.8% is not a premium, it's a confession. The confession is simple. The New York price is not real. It's a paper construct. A derivative of a derivative trading in a leveraged casino where 99% of contracts never touch physical metal. Shanghai is different. Shanghai Gold Exchange operates on physical allocation. You cannot sell what you do not have. Every ounce traded is backed by metal sitting in an SGE vault, which means the 11.8% gap is the market telling you that paper and metal have divorced. And in a divorce, one side keeps the house, the other side keeps the promise. Right now, you're holding the promise. Let me show you the legal architecture that makes this possible. Most people believe they own gold or silver when they buy it through a broker, a bank, or an ETF. The law says otherwise. Under Uniform Commercial Code Section 8-102, the system is called the Indirect Holding System. Here's how it works. You do not own metal. You own a security entitlement. You are not the title owner. You are the entitlement holder. The metal itself is held by a securities intermediary. That's the legal term for your bank, your broker, or your custodian. You see, in the old system, ownership was simple. You bought a bar of silver. You held the bar. You owned the bar. Title and possession were one. In the modern system, ownership is layered. The metal sits in a vault controlled by the intermediary. You hold a claim against the intermediary. The intermediary holds the metal, which means your relationship is not with the metal. It's with the intermediary. And here's the black magic buried in Section 8-503. If the securities intermediary faces insolvency, your security entitlement becomes an unsecured claim against the intermediary's estate, not against the metal, against the estate. You see, in bankruptcy law, there is a hierarchy. Secured creditors get paid first. They have a direct claim on specific assets. Senior bondholders, derivative counterparties, central clearing organizations. Unsecured creditors get paid last, if anything is left. Under UCC Article 8, your claim to the metal is subordinate to the intermediary's senior obligations, which means if JP Morgan holds your silver as a securities intermediary and JP Morgan enters liquidation, your metal is not yours. It's theirs. And their creditors get it before you do. This is not theory. This is the legal structure of the indirect holding system. Plus, the 2026 debt cycle just made this structure radioactive. Let me show you the mechanism that turns your entitlement into their collateral. Dodd-Frank Wall Street Reform Act. Title II, Orderly Liquidation Authority, passed in 2010, designed to prevent a repeat of the 2008 Lehman Brothers collapse. Here's the stated goal. If a global systemically important bank faces failure, the FDIC steps in and liquidates the institution in an orderly manner to protect the financial system. Here's the actual mechanism. The FDIC becomes the receiver. It takes control of the bank's assets and liabilities. It converts unsecured claims into equity. It wipes out shareholders. It imposes losses on creditors to recapitalize the institution. This is called a bail-in. You see, in 2008, the government bailed out the banks with taxpayer money. $800 billion. The public paid the price. In 2026, the law allows the banks to bail themselves in with depositor money and creditor claims. The account holders pay the price. And under Title II, your security entitlement is classified as an unsecured claim. Which means if JP Morgan holds your paper silver and JP Morgan faces liquidation due to the commercial real estate maturity wall, the FDIC can convert your silver claim into JP Morgan equity to save the system. You don't get your metal. You get shares in a failing bank. Plus, this is not a conspiracy. This is the explicit legal framework written into Dodd-Frank Title II, Section 204. The law states, the FDIC may treat claims of similar class equally, but may differentiate among claims based on the nature of the claim or the identity of the claimant. Translation, the FDIC decides who gets paid and who gets converted. And in a systemic crisis, retail entitlement holders are the last in line. Let me add the timeline. The commercial real estate maturity wall hits in late 2026. $750 billion in CRE debt comes due. Regional banks are holding hundreds of billions in unrealized losses on these loans. If those banks fail, the FDIC triggers Title II. If JP Morgan or Citigroup is the securities intermediary holding your metal, your entitlement becomes their equity buffer. The math is brutal. The law is clear. Your claim evaporates. The physical gap as a warning signal. You see, the 11.8% premium in Shanghai is not random. It's rational. Chinese buyers understand the indirect holding system. They understand UCC Article 8. They understand that paper claims are subordinate to physical possession, which means they are willing to pay $110.17 per ounce in Shanghai for metal they can touch, rather than $98.50 in New York for a claim they cannot enforce. The premium is the price of certainty. Let me show you the inventory data that confirms this. COMEX. Registered silver inventories have collapsed 22% since September 2025. As of February 2nd, 2026, Registered inventories sit at 415 million ounces. That's the metal actually available for delivery. Total open interest in COMEX silver futures is 620,000 contracts. Each contract is 5,000 ounces. That's 3.1 billion ounces of paper claims, 415 million ounces of physical metal, 3.1 billion ounces of paper claims, a leverage ratio of 7.5 to 1. You see, COMEX operates on fractional reserve. Most contracts settle in cash, not metal. The system works as long as no one asks for delivery. But in 2026, the physical demand is spiking. Central banks are buying. Sovereign wealth funds are rotating out of bonds. Retail investors in Asia are fleeing digital claims. The drain is accelerating. And when the inventory hits zero, the paper price becomes meaningless. Shanghai already knows this. That's why they're paying the premium. New York is pretending the paper market still matters. That's why they're crashing the price with margin hikes. The divergence is the tell. One market is real. One market is rigged. The legal checkmate, why your metal is not yours. Let me tie this together. Under UCC Article 8, you own a security entitlement, not metal. Under Dodd-Frank Title II, your entitlement is an unsecured claim. In a 2026 bank liquidation, the FDIC converts unsecured claims into equity to recapitalize the system, which means your silver claim becomes JP Morgan stock. Your gold claim becomes Citigroup stock. The metal stays in the vault. The creditors take it to satisfy senior obligations. You get a share certificate in a failing institution. Plus, this is not a future scenario. This is the legal framework active right now. The only variable is the trigger. And the commercial real estate maturity wall in late 2026 is the most likely catalyst. You see, CRE loans are coming due. Banks cannot refinance at current interest rates. Defaults are inevitable. Regional banks collapse. Systemically important banks face liquidity crunches. The FDIC invokes Title II. And the moment they do, every security entitlement held by that intermediary becomes subordinate to the recapitalization. The math is mechanical. The law is surgical. The outcome is guaranteed. The only price that matters, let me give you the framing. The New York price is the paper price. It's controlled by margin requirements, algorithmic trading, and leveraged speculation. CME can crash it with a margin hike. The Fed can manipulate it with policy signals. The Shanghai price is the physical price. It's determined by supply, demand, and the willingness of real buyers to pay for real metal. The 11.8% gap is the market pricing and legal risk, the risk that your paper claim is worthless in a systemic crisis. You see, if you hold physical metal in your possession, you own it. Title and possession are one. No intermediary, no UCC Article 8, no Dodd-Frank Title II. If you hold paper metal through a broker, a bank, or an ETF, you own a claim. And that claim is subordinate to the intermediary's creditors. The premium in Shanghai is the price of eliminating that risk. The crash in New York is the price of ignoring it. But even this legal checkmate is not the endgame. You see, this exact script has played out twice before, 1980, 2011. Both times, the regulators changed the rules mid-game to protect the system and liquidate the holders. And the fingerprints from those two events are identical to the margin hikes we just saw on January 30th, 2026. History doesn't repeat, but the protocol does. Let me show you the pattern. Silver Thursday, the 1980 prototype, March 27th, 1980. Silver collapsed from $50 per ounce to $10.80 in 4 days. The Hunt brothers lost billions. The market called it a crash. The regulators called it stability. The data calls it a protocol. You see, Nelson Bunker Hunt and William Herbert Hunt spent the late 1970s accumulating physical silver. They bought futures contracts. They took delivery. They removed metal from the market. By January 1980, the Hunt brothers controlled an estimated 200 million ounces of silver, roughly half the deliverable supply in the United States. The price surged. $10 in 1979, $30 by December 1979, $50.35 on January 21st, 1980. The Hunts were not speculating, they were cornering, and the system does not tolerate corners. You see, COMEX did not beat the Hunts with better trades or superior capital. They beat them by changing the rules. January 7th, 1980, COMEX introduced Rule 7, Silver 7. The rule was simple. No new long positions allowed. Only liquidation orders accepted. Which means if you wanted to buy silver futures, you couldn't. If you wanted to sell, you could. The market became one-directional, sell only. Plus, COMEX raised margins multiple times. In a span of weeks, margin requirements jumped from 10% to over 50%. The Hunts were leveraged. They needed to post more cash. They didn't have it. Brokers issued margin calls. The Hunts couldn't meet them. Forced liquidation began. March 27th, 1980, Silver Thursday. The Hunt brothers defaulted on their margin obligations. The price collapsed. $50 to $10.80. The regulators called it a necessary intervention to prevent systemic risk. The forensic record calls it regulatory liquidation. You see, the Hunts were not wrong about silver. They were right. The metal was undervalued, the dollar was being debased, physical supply was tight, but the system does not reward being right. It punishes being illiquid. And in 1980, COMEX used margin requirements and rule changes to force illiquidity on the largest silver holders in the world. The protocol worked. The corner was broken. The system survived. The Sunday Night Massacre, 2011. Fast forward 31 years, May 1st, 2011. A Sunday night, silver is trading at $48 per ounce. Gold is approaching $1,500. Retail demand is surging. Sovereign debt crises are accelerating in Europe. CME raises silver margins 5 times in 8 days. May 2nd, margins increased 9%. May 5th, margins increased 13%. May 9th, margins increased 18%. May 11th, margins increased 21%. May 13th, margins increased 16%. Total increase 84% in 8 days. You see, the margin hikes did not correspond to volatility. Volatility came after the hikes. The hikes caused the volatility. Silver crashed from $48 on April 28th to $33 by May 12th. A 31% collapse in 2 weeks. The narrative blamed margin speculators, leveraged longs, frothy retail. The data shows a coordinated flush. Plus, this was not isolated to silver. CME raised margins on crude oil, copper, and gold simultaneously. A multi-commodity liquidation event designed to drain liquidity from hard assets and funnel it back into the banking system. You see, 2011 was the European sovereign debt crisis. Greece, Portugal, Spain. Banks were sitting on billions in bad European bonds. They needed liquidity. They needed cash. And the fastest way to generate cash was to force margin calls in the most leveraged commodity markets. The Sunday Night Massacre was not a market correction. It was a capital extraction. The protocol worked. Retail was liquidated. The banks got their cash. The crisis was delayed. 26. The maturity wall protocol. Now let's overlay the current cycle. January 13th, 2026. CME changes margin calculation methodology from flat dollar amounts to percentage-based notional margins. January 30th, 2026. CME raises gold margins from 6% to 8%. Silver margins from 11% to 15%. The playbook is identical. Change the rules. Raise the margins. Force the liquidation. But the scale is different. In 1980, the Hunt brothers controlled 200 million ounces of silver. In 2026, open interest across global precious metals futures represents over $7 trillion in notional value. In 2011, CME raised margins 84% over 8 days. In 2026, CME raised margins 36% in 72 hours and engineered a self-tightening margin structure that scales with price. The mechanism is more efficient, the trap is more surgical, the wipeout is larger. You see, $7 trillion in liquidations did not happen because traders panicked. It happened because the system forced liquidation through margin escalation. And the reason the system needed this liquidation is the same reason it needed liquidation in 1980 and 2011. Debt. The maturity wall. Why 2026? Is the deadline. Let me show you the timeline. Commercial real estate debt is maturing. $750 billion comes due in late 2026 and early 2027. Regional banks hold the majority of this debt. Office buildings, retail properties, multifamily housing. These properties were financed at 3% interest rates in 2020 and 2021. They are now refinancing at 7% interest rates in 2026. The math does not work. Cash flows cannot support the debt service. Defaults are inevitable. Plus, regional banks are already sitting on hundreds of billions in unrealized losses from the 2022 and 2023 rate hikes. Mark to market, many of these institutions are insolvent. The FDIC knows this, the Federal Reserve knows this, the banks know this, which means the system needs liquidity before the maturity wall hits. Real liquidity. Not printed reserves, not digital credits, cash. And the only way to generate that much cash in a short window is to force liquidation in the largest leveraged markets. Precious metals futures, commodity futures, equity index futures. You see, the $7 trillion margin flush on January 30th, 2026 was not a reaction to market conditions. It was a preemptive extraction designed to generate liquidity before the commercial real estate collapse begins. The timeline confirms this. The margin methodology change happened on January 13th, 2 weeks before the flush, 3 months before the first wave of CRE maturities. This was not reactive. This was scheduled. The inventory collapse, physical versus paper divergence. Now, let me show you why the physical market is divorcing from the paper market. COMEX registered silver inventories have collapsed 22% since September 2025. As of February 2nd, 2026, registered inventories sit at 415 million ounces, a decade low. You see, registered inventories are the only metal available for physical delivery. Eligible inventories are stored at COMEX warehouses, but not available for immediate settlement. 415 million ounces. That's the real supply. Open interest in COMEX silver futures, 620,000 contracts. 3.1 billion ounces of paper claims. The leverage ratio is 7.5 to 1, which means for every ounce of deliverable metal, there are 7.5 ounces of paper claims betting on that metal. This is fractional reserve, and it works until someone asks for delivery. But in 2026, delivery requests are spiking. Central banks, sovereign wealth funds, large institutional buyers in Asia, the drain is accelerating. And the more metal that leaves the warehouse, the more fragile the paper structure becomes. You see, CME can crash the paper price with margin hikes, but they cannot create physical metal. And when the physical supply runs out, the paper price becomes irrelevant. Shanghai already understands this. That's why they're trading at an 11.8% premium. They know the COMEX price is a derivative of a fractional system that is running out of collateral. New York is still pretending the paper market sets the price. That's why they're using margin liquidations to defend the illusion. But the inventory data does not lie. 415 million ounces registered, 22% collapse in 5 months. The physical market is screaming. The protocol never changes. Let me connect the pattern. 1980. Change the rules, raise the margins, liquidate the holders. 2011. Change the rules, raise the margins, liquidate the holders. 2026. Change the rules, raise the margins, liquidate the holders. The protocol is mechanical. The system does not care about fair markets. It cares about liquidity. And when the debt cycle demands liquidity, the regulators will change the rules to extract it from the most leveraged participants. You see, the Hunt brothers were right about silver. Retail in 2011 was right about the sovereign debt crisis, and the longs in 2026 are right about monetary debasement. But being right does not protect you from liquidation. Liquidity protects you from liquidation. And in a fractional reserve paper market controlled by CME margin desks, liquidity is a weapon they control. The Shanghai premium is the market telling you to exit the paper system. The COMEX crash is the system telling you that exit costs everything, but even knowing the protocol does not give you the solution. You see, the real trap is not in the margin hikes or the fractional reserve. The real trap is in the choice you make after the crash, because most will react by doing exactly what the system wants. And that final decision determines whether you survive the 2026 reset or become the collateral that funds it. Let me show you what comes next. Most will call this a crash. We call it a transfer. You see, $7 trillion did not vanish. It moved from leveraged longs to senior creditors, from paper holders to physical holders, from those who trusted the system to those who understood the protocol. The January 30th liquidation was not a market failure. It was a wealth extraction event designed to recapitalize the banks before the commercial real estate maturity wall collapses the regional system. And the 11.8% premium in Shanghai is the forensic evidence that the transfer is already complete. If you're the type who refuses to be the exit liquidity for the 1%, join the forensic circle. Subscribe. We track the fingerprints they try to erase. We document the mechanisms they hope you never read. And we provide the timeline before the deadline hits. Because the next phase of the 2026 cycle is already in motion, and the margin trap you just witnessed is only stage 1. Let me leave you with the only math that matters. Paper can be printed to infinity. Metal cannot. The $11 premium in Shanghai is the world telling you that the New York price is a lie, a derivative, a fractional claim backed by 415 million ounces and leverage 7.5 to 1. You see, UCC Article 8 does not care about your intentions. Dodd-Frank Title II does not care about your expectations. The law is explicit. Your entitlement is subordinate to the intermediary's creditors. Which means the only question left is this: will you hold the metal, or will you hold the entitlement? Title and possession, or a security entitlement and a prayer. The 2026 deadline doesn't wait for your permission. The maturity wall is coming. The liquidations have started. And the Shanghai premium is rising. The protocol never changes. The cycle always completes. And the system will take everything you let them classify as a claim. The forensic record is clear. The math is final. The choice is yours.